Now we are moving to section 2. There are 4 questions, each will give 10 marks, that means 40 marks will be given. The recommended time period 72 minutes, right. Okay, question number 2, we will look at this illustration, it will give 10 marks and you have to spend maximum. The maximum duration you can spend is 18 minutes. You can spend 18 minutes. Within 18 minutes, you have to attend this illustration. Okay, we'll read what it says. Crystal Insurance Broker CIB, Private Limited, is a well-known insurance brokering company that serves both individual and corporate customers in their annual general insurance requirements. Like they are servicing to corporate client and individual client, right. It recently performed a customer profitability analysis. Now they are doing CPA. Okay, you need to identify which type of customer group is more attractive or more profitable, which are not. They have recently performed a CPA following the activity-based costing technique. Okay, activity-based costing technique on corporate customers and was stunned with its outcomes, right. CIB is now planning to extend the same exercise on its individual customers. You have carried out the CPA for the corporate clients. Now we want to do that CPA for individual clients, right. We'll see. The company has 3 individual customer subgroup. There are 3 individual customer subgroup here. It has been given. Retired seniors and stay-at-home mothers, right. Professionals in practice like us. Non-professionals in employment like entrepreneurs. Assume. Okay, the company has 3 individual customer subgroup and the following details for the past year were submitted by its business analyst. Okay, business analyst provide the information about 3 customer subgroups. Okay, these are relevant individual customer subgroups. Retired seniors, professionals in practice and non-professionals in employment, right. Premium value of the policies generated 72 million, 48 million and 64. That is the premium value, right. Then number of clients, here 300 client, 100 and 200, that is the customer segment. Each customer in retired seniors, there are 300 customers. Number of inquiries by existing clients for new policies. 700 inquiries but success only 300. 150 inquiries, success rate is 100. 350, now it is 200. Okay, we'll see. Number of policies sold, 300 individual, 300 policies sold. Professionals in practice, 100 individual but 220 policies sold. That means assume you are a professional. You might have taken different policies. You might have taken a policy for health, then another policy for your children's education, there's another policy for your retirement benefit. Likewise, in a professional, they might take more than one policy. As an individual, I may prefer 2 or 3 policies based depending on my capacity, right. Non-professionals, they have obtained total new policies sold 280. Some people might have taken 2, some people might have taken 3. Number of client visits by sales agent, 500 sales visits, only success rate 300. 100 visits, 100 sales, 100 customers. 150 visit, 200 customers. Okay, right. The following are the period cost and revenue details recognized for individual customers during the past year. Okay. Now you are an insurance broker. Broker mean you are an intermediary. You will receive a commission. Even though this is a premium value, that doesn't belong to you. That premium value belongs to the insurance company. You are an insurance broker. When you are an insurance broker, you are the middleman, you will earn a commission out of that, right. Here it says, CIB's eligible brokerage net commission is 12% of the premium value. That means you can get 12%, okay, 12% of the premium value. That means 72 million is the retired seniors and stay home mothers, 72 million into 12%, right. You are entitled for 12% of the premium value. That is the revenue. That is the revenue generated to the company, right. Expenses claimed by the sales agent for the client visit were 1.5 million. Where the client visits? These are the client visits. Okay, I will put number 1. Total client visit 500 for retired seniors, 100 for professional, non-professional, 150. All together, how many sales visits they have made? 500, 600, 750. 750 in total. 750 in total. The cost you have spent, they have claimed 1.5 million. Legal and administration cost on policy execution were 2.2 million. 2.2 million policy execution. Number of inquiries made by the client in new policies, right. Okay. Now you can look at number of policies sold, 300, 220 and 280. You have to look at relevant cost driver. These are activities, those activities driven by cost drivers, right. Therefore, you have to identify which are relevant cost and what are the relevant cost driver. Cost incurred on customer inquiries were 1.8 million. Okay, customer inquiries here, these are the customer inquiries, right. What they asked to do? They asked to do, CIB is keen on maximizing its profitability by targeting the most profitable customers. Out of these 3 customers, you have to identify who are the most profitable customer, who are the least profitable customer. Then you need to decide, make a decision whether we are going to service those least profitable customer. Is it mandatory to service? Otherwise, you will shift from least profitable to most profitable customer, or you have to convert least profitable customer to a more attractive customer, right. What it says, target most profitable. However, due to regulatory and business relationships, it cannot fully discontinue customer subgroups. That means even these 3 subgroups are there. You can't discontinue with the legal and regulatory requirement and the current relationship. Then you have to run the business. You have to continue with those segments. What you have to do? You have to increase the profitability. You have to reduce some cost, right. Instead, CIB has developed a few strategies given below to be implemented from the next year onwards. They have documented few strategies. We will see what are the strategies. These strategies will only be applied for one selected customer subgroup, and CIB plans to use the result from the CPA in deciding the covered subgroup for each strategy. Okay, there are strategy, how many strategies? 2 strategies are there. You need to decide which one, which segment should apply this strategy. Okay. First one, sales agents are offered one-time payment of 25,000 per each new client introduced. Clients are charged 1,000 rupees per each sales agent visit, and this amount will be reimbursed subsequently if the visit generate an actual sales. There might be client visit, there won't be any sale. Then it will be a cost to the company, but you will charge, reimburse the cost when it become a actual sales, right. Look at the requirement. Prepare the customer profitability analysis statement for each individual customer subgroup. Now we need to perform profitability analysis. Okay. There are 3 customer subgroup. Okay. What are they? Retired seniors, professionals and non-professionals in employment, right. We need to do the calculation, and I think now you have the paper. Now we will move to calculation, how to calculate their profitability or customer profitability, and is who are the more profitable customer and who are the least profitable customer, right. The customer subgroup: retired seniors, professionals, non-professional. Those are the 3 customer segment. I will take it. Okay. I will go to the whiteboard. Okay. There are 3 customer segment. I will take retired, the one segment. Others are professionals, and non-professionals in employment, non-professionals in employment. Okay, retired, professionals and non-professionals. Now brokerage income, that is your revenue. Brokerage income 12% on premium value. Okay, brokerage 12% on premium value. Premium value, retired seniors, their premium value is 72 million. 72 million multiplied by 12%, the value should be 8,640,000. Okay, retired seniors, their brokerage is 8,640,000. Premium value 72 million, 72 million into 12%. That is the premium value. That is your revenue. Professionals, their premium value 48 million. Out of 48 million, 12% belong to the CIB, insurance broker. Therefore, 48 million into 12%, it is 5,760,000. Non-professionals, their total premium value 64 million. Out of 64 million, 12% apply to the non-professionals. That segment, 12% anyway your brokerage charge. The value should be 7,680,000. Right. That is the brokerage revenue, that is the revenue. Now we have to look at, there are some activity costs which are driven by different activities. Now you need to allocate those support service costs when evaluating the profitability of this client, right. There are 3 expenses. First one, expenses claimed by the sales agent for the client visit were 1.5 million. Therefore, I will take first cost item, first one, cost of client visit, cost of client visit, client visit, client visit, client visit. I will work out here itself. The total cost of client visit is 1.5 million. Okay, I will work out it here. Thereafter, I will wipe it. Cost 1.5 million. right, 1.5 million. Cost is 1.5 million. What is the cost driver? The sales visit cost, client visit cost will change according to the number of visits you have made. Therefore, it has been given number of client visits by the sales agent, okay, number of visits, how many visits? Number of visits made by the sales agent, retired seniors 500, okay, 500 plus 100 for professionals, 100 plus 150 for non-professionals. Altogether 750 visits. 750 visits. Therefore, 750 visits generate 1.5 million cost. That means cost per visit 2000. This is the cost, this is the cost driver, cost per visit. 1.5 million divided by 750, 2000. If you consume more sales visit, more cost will be allocated to you, 2000 per visit, right. Then how many visits consumed by retired seniors? It is 500 visit. So yes, 500 visit into 2000, it will be 1 million. Okay, now we will allocate the cost 2000 per visit, that is the value. Okay, then okay, 500 visit into 2000, you need to deduct 1 million here. Professionals, they have taken 100 visits. 100 visit into 2000, you need to deduct 200,000. 200,000. Non-professionals, they have used 150 sales visit. 150 into 2000, it is 300,000. 300,000, right. That is the first activity. The next activity, legal and administration cost on policy execution were 2.2 million, legal cost. Second one, legal cost. Legal cost is 2.2 million, 2.2 million, right. Legal cost will arise when you execute the agreement. If there is no agreement, legal cost won't arise. No, if it is made to a sale, if you are signing each policy, then there will be a legal binding, right. Therefore, now you have to look at 2.2 million, how to allocate among the retired seniors, professionals and non-professionals, right. Again, I will do the computation here. Cost 2.2 million, 2.2 million. Cost driver, number of policies sold. If you have sold the policies, then you have to have an agreement. Therefore, cost driver, number of policies executed, number of policies. How many policies were executed? Number of policies sold, retired seniors 300, 224 professionals in practice, 284 non-professionals. Okay. 300 for retired seniors, 224 professionals in practice, and 280 for non-professionals. All together, what is the value? 500 and 800. It is 800 policies you have executed, 800 policies. The total cost 2.2 million is spent on drafting or administration of 800 policies. Then what is the cost you need to allocate per each policy? 2.2 million divided by 800, then you will receive the answer. Answer is 2,750 per policy. 2,750 per policy. Each policy you have to allocate 2,750. Now look at retired seniors, they have 300 policies, right? 300 policies into 2,750, then you need to allocate the cost 825,000. 300 policies into 2,750. Now I will allocate the cost. Okay, this is legal cost. Here it should be 825,000. 825,000. Professionals, it should be 605,000. Non-professionals, it should be 770,000. The third cost item, customer inquiry. Look at it, will you? Cost incurred on customer inquiries were 1.8 million. Third one, customer inquiry. Customer inquiries. Total cost 1.8 million. How many inquiries were made by the client? Number of inquiries made by the senior citizens 700. Professionals 150. Non-professional 350. Altogether 1,200 inquiries were made. I am not going to, because similar computation, 1.8 million divided by 1,200, that is each inquiry will cost 1,500 to the company. Therefore, based on 1,500 per inquiry, retired seniors made 700 inquiries. That means total cost inquiry, the cost of handling the inquiry, 1,050,000 should be allocated to this segment. 1,050,000. 1,500 each. 700 inquiries were made. Professionals, they have made 150 inquiries. 150 into 1,500, it is 225,000. 225,000. Non-professionals, they have made how many inquiries? 350 inquiries into 150, sorry, 1,500, value is 525,000. Now, all the activity cost we have allocated, now you can calculate net profit, right? Total net profit according to ABC method. Now, I will work out what is the net profit that you have earned. Net profit. Net profit. Revenue from the client group, retired seniors, these are the additional or support service cost. You will earn 5,765,000 as a net profit. Professionals, you can make 4,730,000 net profit from this particular group professional segment. Non-professional, you will make 6,085,000. 6,085,000. Okay. By looking at the total profit, you can't make a decision. You might say non-professional group is more attractive. No. You have to see how many customers or how many policies you have sold has generated this much of revenue. Okay. Now, if you look at about the retired seniors, 5,765,000 is the net profit. How many clients are there? Number of clients 300, right? This group 4,730,000, this revenue net profit generated by 100 clients, right? Then non-professionals, 6,085,000 generated by 200 clients. Take number of clients, retired seniors 300 clients generated 5.7 million. Professionals in practice 100, non-professional 200 clients. Now calculate profit per client. Profit per client. 5,765,000 divided by 300, you will get the answer. What is the answer you will receive? Approximately 19,217. Right. Professionals, 4,730,000 divided by 100, 47,300. 6,085,000 divided by 200, 30,425. 30,425. By looking at profit per client, now you have to ranking which client you will give the priority. Ranking. Who is the most profitable customer? Professionals are more profitable. Therefore, you will give the first rank to professionals. Non-professional with employment, they will give 30,425. Then second priority will give to them. Then these are the least profitable customer group. Therefore, that's how customer profitability analysis you can perform for the first part of the illustration. Okay. This is the question number 2, part A. Question number 2, part A. Clear? I think this is clear. Now you have done the customer profitability analysis. Up to this point you have earned 6 marks. Now we have to see what is the requirement. There are 2 strategies. First strategy is to, what is the first strategy? Sales agent are offered one-time payment of 25,000 per each new client introduced. If you give 25,000 for the new client being introduced, is it suitable for retired seniors? No, you will generate a loss. If they introduce a new client, they will generate net profit of 19,270. If you given another 25,000, then you will generate a loss. Therefore, that strategy 1 offering 25,000 commission, one-off commission to the sales agent for the business they have introduced for the retired seniors, it is not feasible, it is not suitable. Therefore, the strategy 1 not suitable for retired seniors. But if you look at about professionals and non-professionals, both, if you look at both segment, professional segment will give you a 47,300. If you offer, if you encourage to get new businesses while offering 25,000, you can earn 47,300 minus 25,000, 22,300 as a net profit. One strategy will be applicable for one segment. That strategy is more suitable. It is more suitable. Why? It will give a larger contribution with compared to non-professional even. Therefore, it is more suitable. Strategy 1 is suitable for professional segment. You can write down like that. Okay. On the other hand, in this section, each 100 clients, how many policies? There are 220 policies. Success rate is 220% or 2.2 the success rate. One client 2.2 as the average. Therefore, this is more attractive segment. You can increase the revenue, you can increase the profitability if you give the 25,000 incentive or one-off commission to the customer who are the people who are introducing professional segment, right? That is more profitable. Then strategy number 2. What is strategy number 2? Clients are charged 1,000 per each sales agent visit, and this amount will be reimbursed subsequently if the visit generate an actual sales. Look at it, who will spend more? Retired seniors will take more client visit. Out of total sales visit are there 750. Out of 750, 500 visits for retired seniors. That means 300 clients are there, 500 visits. That means more visits, some are unproductive visits. It can be demotivated or discouraged if you charge them if they want a sales visit. Then you can save some cost. This cost can be reduced. Then you can recover some part of it. Now they are proposing 1,000 per client visit. If you recover 1,000, if it is not generated any revenue, then you can reimburse that cost. Therefore, it should be more suitable to the retired senior category, but in the long run, it may not be suitable because you will lose the reputation in some juncture. Therefore, some situation you might lose that option. Therefore, it is in short term it will be beneficial, but long run you should see some option to reduce the cost. Right? Okay, I will move to paper. Give me a second. Okay. Based on the strategies suggested, okay, second, clients are charged 1,000 per each sales agent visit, and this amount will be reimbursed subsequently if the visit generate an actual sales. If you look at the suggested answer, okay, it says about if you follow the strategy 1, this is the answer, because if you generate, if you apply 25,000 commission to each agent, if you apply it for the retired seniors, you will generate a loss of 5,783. Therefore, that strategy is not suitable, right? But you can earn a marginal profit out of this one. 30,425 minus 25,000, you will earn 5,425 as a net profit. It's a marginal, but if you apply that strategy for the professional in practice, you can earn 22,300. Therefore, strategy 1 suitable for professionals in practice. Then strategy 2, charging sales commission. Look at customer inquiry handling. Sorry, client visit 1 million, because they are taking how many client visit? 500 visits. Then you can save such cost here. It has been mentioned here. This strategy aims to control the cost of sales agent due to non-value addition to the sales agent visits. Looking at the statistics, the generation of new policies by sales agent visit less than 1%, that is 60% for the retired seniors and stay at home mothers category. Therefore, you have to discourage them. Therefore, that is the way to reduce the cost, and that is the way to improve your profitability of the customer segment. Right. That is the answer for part B. Discuss suitable strategy. Strategy 2 is suitable for retired seniors. Strategy 1 suitable for professionals in practice. Clear? Hope you have understood. That is the end of question number 2. We have done the customer profitability analysis, 6 marks. Thereafter, we have discussed the suitability of the strategy. 25,000 discount you can offer for the customer group. Number 1 customer group, that is the professionals in practice. You can earn a reasonable margin, right? But retired seniors, if you introduce that 25,000, because currently you are earning 19,260, right? Therefore, you will generate a loss. Better if you introduce strategy 1 for the professionals in practice. You can charge 1,000 rupee per visit, because client visit these retired seniors, they consume more client visit. You can, strategy 2 can apply for the retired senior category. That is the answer for question number 2. Right. Now we will move to question number 3. This is relating to profit maximization. You have to find out what is the optimal pricing range which will maximize overall entity profitability. Profit maximizing revenue, profit maximizing price and quantity, you have to find it out. Now, this information you can read it and look at whether this is what is the suitable pricing mechanism. It has given 10 marks for this illustration. Okay, we will read. Lifeguard Private Limited LPL is a pharmaceutical company that researches, develops and manufactures a wide range of vaccines and drugs, which is more relevant to the pandemic we have recently faced, COVID-19 pandemic. Okay, now they are developing this vaccine. The recently developed Covivax, a vaccine with an efficacy rate of 89% for the coronavirus causing COVID-19, because we have, I think you all have taken the vaccines, okay, even booster, right? They are giving Covivax, that is the name of the vaccine. The management of LPL expect a market for this product of 4 years, okay. They will plan to sell this for 4 years, because after 4 years, this virus will be disappear, they expect. Now, different versions are there, but they expect within 4 years it will be disappeared. Your sales will be remain over next 4 years, which will thereafter gradually come down. Based on the research information on the current demand level for the vaccine, the estimated prices and respective annual demand levels are given in the following table. Okay. Now look at price per vial. That means price per vial means it's a kind of bottle that contain the vaccine, right? Rupees 1,000, demand 10 million vials, right? When the price increased to 1,002 by 2 rupees, demand will fall from 10 million to 9.98 million by how much? 20,000 is the price drop. If you increase the price by 2 rupee, the demand quantity will fall by how much? 20,000. That is the slope. right? If we increase by another 2 rupees, that means 1004, demand will fall, another 20,000 demand will fall. Now you have to identify the relationship. That means when demand falls by, when price increase by 2 rupees, demand will fall by 20,000 unit. Got my point? Delta P is 2, delta Q is 20,000, right? Delta P divided by delta Q, then you will get the slope, right? That is B. Note, a vial is a small glass container filled with 10 milliliters of the vaccine, right? It is 10 milliliters because each bottle, it's a kind of glass container filled with 10 milliliters of vaccine, right? That's there. Okay. Production of Covivax will be made in identifiable batches, each containing 100,000 vials. 100,000 vials mean in order to manufacture 10 million, how many batches need to be produced? If it is 10 million, you have to produce 100 batches, right? Vials. A vial is capable of vaccinating 20 persons. A vial is capable to vaccinate 20%, right? Each vial of Covivax is currently made using the following ingredients. Ingredient XX, 2 milliliters at rupees 100,000 per liter. That means each contain 10 milliliters of vaccine. Out of this 10 milliliters, 2 milliliters for material XX, ingredient XX. The price per 1 liter of XX is 100,000, right? Then if it is 2 milliliters, 1 liter contain how much? 1000 milliliters. Then 1000 milliliters will cost about 100,000. Then 1 milliliter cost at how much? 100 rupee, right? Ingredient YY, 8 milliliters at 25,000 per liter. Then that means 25,000 per liter mean it will be 25 rupees per milliliter, right? Now you have the, each bottle contain how much? 10 milliliters of vaccine. Each vial contain 10 milliliters of vaccine. That 10 milliliters, this is the composition, right? Okay. That means if you want to manufacture one vial, the material cost would be how much? You can easily calculate it. I will do the rough calculation here. 2 milliliters at 100,000 per liter. This is 100,000, right? This is for 1000 ml, 1000 milliliter. You required how many milliliters? 2. That means 200, right? That is for ingredient XX. Ingredient YY, 8 milliliters required per vial, currently cost at 25,000 per liter. Now you have confused liter and milliliter measurement. 1000 milliliters equal to 1 liter. Now therefore 25,000. This is for 1000 milliliters. Then you required 8 milliliters, that means 200. Simply your material cost is 400. If you produce one vial mean total demand is 10 million, material cost of a vial is 400, right? That's done. The estimated annual labor and production overhead cost of producing Covivax under two different output levels are as follows. Look at it, will you? In 90 batches, labor cost 500 million, 100 batches it is 550. Now, your cost increased by 50 million when you increase the number of batches 90 to 100. That means 10 batches will cost how much? 50 million. One batch will cost around 5 million. Then 5 into 90, 450, but actual value is 500 million. That means it includes fixed cost as well. Then you have to remove that one as well, right? That means if you look at the cost value, I will take the value. Labor cost, you have to take high-low method. Now 90 to 100 batches net change. Here 10 batches. 10 batches. Delta 10. When batches increase by 10, the cost increase by 500 to 550 million, the change is 50 million. Here it is 280 went up to 300 million by 20 million. Simply, now you can calculate the marginal cost and you have to split into fixed and variable. I think you have written them down. Okay. What they asked to do? Assess the optimum profit maximizing selling price for Coivax and resulting profit for the next year. That means simply you have to calculate profit maximizing product mix, price and quantity. When we are going to do that, can you remember the things you have learnt in economics and things you have learnt in the business level and corporate level? Your profit will be maximized when MC equal to MR, the essential condition. Marginal cost equal to marginal revenue. Therefore, you have to find out total revenue function and total cost function. Thereafter, you have to differentiate them. Then marginal cost and marginal revenue, you have to find it out. Okay, first we will find out what? Marginal cost per VL. That means you have to find out marginal cost per unit, because fixed cost will not vary with the output. Therefore, you can easily remove the fixed cost when we are going to calculate profit maximizing price and quantity. Because the condition, can you remember, you have already learned this one, profit will be maximized when MC equal to MR, MC equal to MR, marginal cost equal to marginal revenue. In the marginal cost mean when you increase the output by one additional unit, what is the additional cost added to the total cost? That is marginal cost. Therefore, fixed cost you should not consider when calculating profit maximizing price and quantity. That keep in mind, this is the essential condition in maximizing the profit. MC equal to MR. Okay. Now, we are going to calculate. First, we will look at what is the marginal cost of the given illustration. Thereafter, we will look at marginal cost and fixed cost will be taken when we calculate the profitability. Right. Okay, first one, because here also you need to find out what is the relevant marginal cost for labor and variable production overhead, you have to split. Right. You have already find out the material cost. I will move to the whiteboard. It's not whiteboard, but it's green board, but I think you can see this one. Right. First, we will find out marginal cost first. Materials. Material. We are using two types of material, ingredient XX, ingredient YY. XX, ingredient XX. Cost per liter 100,000. We have already done this one. Cost per liter 100,000 per liter. 100,000 per liter. Now we required each unit 2 ml, 2 milliliters. Therefore, this is 100,000 per liter. Then you can see 100,000. This is for a liter, right? 1000 ml. You required only 2 milliliter. Then value is 200. 200. Ingredient YY. Ingredient YY. It was 25,000. 25,000 per liter. Then 25,000 divide by 1000. 25 rupees per each milliliter. We required 8 milliliter. Then it is 200. The total material cost per vial. Vial mean, assume it is a one bottle that contain 10 milliliters. Okay, 10 milliliters, 2 milliliters from XX, 8 milliliters from YY. Total cost per vial, the material cost per vial is 400. It will be vary. It is a variable cost. Therefore, direct material cost will be 400. 400. Direct material cost 400. That's done. Therefore, you can say, therefore, material cost per vial. Material cost per vial, assume unit vial equal to 400. You have done it. Then we will look at labor and other overhead. Okay, labor and overhead. Labor. Labor. When we are going to calculate labor cost, here it has not given directly what are the variable labor cost and what is the component of fixed labor cost. But they have given me two different capacity level, right? Okay, now we will look at what is the variable component. In 90 batches, 90 batches and 100 batches. Labor cost. At 90 batches, labor cost is 500 million. 500 million. When it increased to 100 batches, the cost of labor will increase up to 550 million. 550 million. What has happened? When you increase number of batches 90 to 100 by 10 batches, the cost increased by 50 million. Okay, you can look at the change. Here, you increase the batch size by 10, cost increase by 50 million. Now you know that if you increase the volume, if the cost also going up, that is variable cost. Then what is the variable cost per batch? If you increase the batch by 10 batches, cost will go up by 50 million. That means variable cost per batch is 5 million. Right, I will write it down. Variable cost per batch equal 50 million divide by 10 batches, that is 5 million. Now you need to identify variable cost per batch is 5 million. If all are variable cost, when you produce in 90 batches, total variable cost should be 5 million into 90. Total variable cost TVC at 90 batches equal 5 million into 90 batches equal 450 million. But at 90 batches total labor cost 500 million. Total variable cost 450 million. There is a difference. What is that? Okay, your total cost 500 million at 90 batches. Total cost, remember it is total cost. $90 batches, 500 million. Then what is the balance 50 million? That balance 50 million is the fixed labor cost. Please note it that fixed labor cost. Fixed cost 50 million. Fixed cost 50 million. Here it says that production of Covivax will be made in identifiable batches, each containing 100,000 vials. Each batch contain 100,000 vial. Variable cost per batch 5 million. Each batch manufacture how many you need? 100,000. Then you can calculate variable or labor cost per vial. Per batch 5 million is the variable cost. Per batch you will manufacture 100,000. Then 5 million divided by 100,000, it will be 50 rupees. Okay, variable labor cost per vial is 50 rupees. I will take it later. Then this is for labor. Now you have split variable labor cost per batch 5 million. Okay, then we will work out overhead, production overhead. Production overhead. Production overhead. Production overhead. Same scenario at 50 batch, 90 batches. Cost is 280 million. At 100 batches, cost is 300 million. Simply, total number of batches increased by 10 batches. Change is 10 batches. Cost change is 20 million. Therefore, variable cost per, if it is increased by 10 batches, the cost has increased by 20 million. Therefore, variable cost per batch, how much? 20 million divide by 10. The cost will be 2 million per batch. Cost per batch 2 million. Now you have to split into variable and fixed. Now at 90 batches cost is 280 million, right? Then I need to split. At 90 batches total cost 280, cost per batch, variable cost per batch 2 million. If it is 2 million, total variable cost, you can calculate 2 million in each batch, number of batches 90. The total variable cost should be 180 million. 180 million. But the total cost of 90 batches is 280. That means TFC, total fixed cost, equals to 100 million, right? 100 million is the total fixed cost. Now total variable cost 180 million, that means 2 million a batch. 2 million, that is production overhead cost per batch is 2 million. If you look at labor, variable labor cost per batch is 5 million. Now you can calculate, what you can calculate? Variable cost per batch, right? Variable labor cost per batch. Variable labor cost per batch 5 million. Variable production overhead per batch 2 million. Total, here it is total 7 million. Number of VLs per batch, number of units per batch, is given 100,000. Then you can look at per unit cost, per unit. 5 million divided by 100, it is 50 rupee per unit labor cost. Here 2 million divided by 100, it is 20 rupee per unit, right? Now I have the variable labor cost, variable overhead, production overhead, and if you go back, I have already found material cost 400. Now I have the variable cost per unit, that is the marginal cost. When the output goes up, the total variable cost also going up. Therefore, I will come back to this one, and now we will write it down. Direct material per unit. Direct material, you have already found 400 per unit direct material. Then variable labor cost, per unit. You have already found 50 rupees. Variable production overhead, you have already found 20 rupees. 20. Now you know the variable cost per unit, or we can call marginal cost per VL or unit, VL. Marginal cost per VL or marginal cost per unit, take the total, it will be 470. Now you know MC, but you have to find out MR, marginal revenue. In order to develop marginal revenue function, you have to develop total revenue function. Okay. You have developed total revenue function. Therefore, you have to use the demand function. What is the demand function? P equal to A minus BQ. Right. MC is available. Now we are going to find out MR. Right. I will take this one. Now we are going to find MR. Don't interpret in different way. MR is marginal revenue. You are going to find out marginal revenue, right? Development demand function. First, you need to develop demand function. Develop demand function. Can you remember the demand function? P equal A minus BQ. P equal A minus BQ. Right. What is the meaning of B? Now you have already learned this one from your advanced level studies, economics. In economics, you have learned under perfect market condition, the profit will be maximized when MC equal to MR. And when you are going to develop demand or market equilibrium, you know this one. Now we look at this, the price. Okay, equilibrium, assume equilibrium price. A and B, what are the symbols? First we will look at B. B is the slope. Okay, B. First I will define B. What is the meaning of B? That is the slope. Delta P divided by delta Q. Change in price divided by change in quantity. Therefore, B is the change in price, delta P divided by delta Q. Can you remember in the given illustration, when the price went up from 1000 to 1002 by 2 rupees. Okay, if I say delta P equal, when price increased from rupees 1000 to 1002, that is the delta P, 2 rupee change. What has happened? Quantity drop from 10 million to 9.98 million. 10 million minus 9.98 million. Simply, when your price decreased by 2 rupee, it is anyway negative, no? Price and demand, price and quantity, there is a negative relationship in demand function. When price increased by 2, then here the relationship quantity drop changed by how much? Quantity changed by 20,000. 20,000. Simply, slope is 0.0001. 0.0001. B is 0.0001. Okay, simply when price changed by 2 rupee, quantity changed by 20,000. Anyway, negative relationship. Right. Then A. What is the meaning of A? A mean what is the price which demand equal to 0. Now you know the P equal A minus B is 0.0001 Q. Right. Now we want to find out what is the value of A. How to find it out? Look at when your price is at 1000 rupee, your demand is 10 million, right? When your price at 1000, your demand is 10 million, then you can easily find out A. Therefore, I will find out A at 1000 rupee, or you can say when P equal to 1000. When P equal to 1000 rupee, that is P, A minus 0.0001 Q is 10 million. 10 million. Simply 1000 equal A minus this value is 1000. That means A equal to 2000. If the price is 2000, your demand quantity is 0. Then you can easily write down your demand equation. How? P equal to 2000 minus 0.0001 Q. This is your demand equation. P equal 2000 minus 0.0001 Q. That is the demand equation. Now, how to calculate the revenue? This is price equation. Your revenue is P into Q. Mila වැඩි කිරීම ප්‍රමාණය, price into quantity. Okay, now we will derive total revenue function. Total revenue equal P into Q, price into quantity. Now your total revenue P equal to 2000 minus 0.0001 Q. That is the price, right? Now price is 2000 minus 0.0001 Q. Now quantity, you have to find the quantity multiplied by Q. Then your total revenue function equal total revenue 2000 Q minus 0.0001 Q square, right? This is your total revenue function. Now you know the total revenue function. Now you have to find out the marginal revenue function. That means you have to differentiate this function in order to find out the marginal revenue function. TR1. Okay. Then marginal revenue, this q 2000 q power 1, right. Therefore, 1 into 2000 it is 2000, right. q1 minus 1 q0 minus 0.0001 into 2 power 2, 2 into 1 it is 2 q square minus 1. Then your marginal revenue equal 2000 into q 1 minus 1 it is q0. When the power is 0, value is always 1. 1 into 2000 it is 2000 minus 0.0002 q 2 minus 1 it is q1, it is 2q, right. 0.0002q. This is your marginal revenue function. Now you know your marginal revenue function, and on the other hand you have your marginal cost function, marginal cost per VL 470. Now your marginal revenue per VL equal to 2000 minus 0.0002 q. Now you need to find out profit maximizing price and quantity, right. Now we will work it out. We will write it down. Profit will be maximized, when MC equal to MR. MC equal to MR, your profit will be maximized when MC equal to MR. Okay, we will do. Your MC is 470 equal your MR, marginal revenue, 2000 minus 0.0002 q, right. Then 0.0002 q equal, this will go to other side, 2000 minus 470, that means 1530. Then q equal 1530 divided by 0.0002. Q equal, what is the q? Take the value for q, $7,650,000. That number of VLs are, that units are 7,650,000. That is the quantity. Now you know the quantity, now find the price. Okay. Price equal, P equal 2000 minus 0.0001 q. That is the price equation we have already written. Now you have already find out the quantity. You know the quantity, now find the price. Very simple. Okay. Now since we have the computation, you can go backward and see how we have arrived this answer. Because now those days like a whiteboard, if we write off, it will be out. Now it's there, you can go back and see the history what we have done, right. Now your price equation we have already calculated, P equal 2000 minus 0.001 q. Now we will come forward. Now P equal P equal 2000 minus 0.0001, Q is 7,650,000. Then answer 2000 minus 765, P equal 1230. 5 is the profit maximizing price. Profit maximizing price is 1235. That is the price. Now you know the variable cost 470. Now it asks to calculate profitability, right? Net profit you have to calculate. This is the price. You have the quantity 7,650,000. Now we will look at what is the net profit that they will earn. Okay. I'll take one selling price. Selling price 1235, right? 1235 less variable cost, less variable cost or marginal cost. You have already found variable cost per unit 470. 470. Take contribution per unit. Contribution per unit. Per unit. Contribution per unit. 1275 minus 470. It will be 765. Okay. 765. 765 per unit, right? Then sales quantity. Sales quantity we have already found in here. Quantity 7,650,000. We have already found 7,600,000. 7,650,000. Therefore, total contribution total contribution 765 is the contribution per unit. Total sales 7,650,000 units. The total will be rupees million 5,852.25 million contribution. Then you have to find the profit, no? Then you have to deduct fixed labor cost. Fixed labor cost. Can you remember what is the value of fixed labor cost? Okay, go back and see. You have already found it somewhere else. Here you can say total variable cost, fixed labor cost 50 million, right? Then production overhead, fixed cost 100 million, right? We have already found the values. This is the final answer, right? Fixed labor cost 50 million. 50 million you have to deduct. Fixed production overhead, fixed production overhead, it is 100 million. Then you can get the final net profit. Net profit, net profit, net profit, it should be 5,702.25 million. That is the final answer. That is the answer. It has given 7 marks. Okay, 7 marks. Right. Clear. I think the total computation is clear with you. It is a like there's a 10 steps. If you go back and see what we have done. Initially, we have calculated the material cost. In the second step, what we have calculated, we have split the labor cost into fixed and variable. Then production overhead, we split based on high-low method, we split into fixed and variable production overhead. Then you have calculate variable direct labor cost, variable production overhead. Then you have compute the marginal cost per unit. Thereafter, you need to calculate marginal revenue function. For that, you have to demonstrate, you have to calculate demand function. We have calculated it. Then we have calculated marginal revenue function. Then we have calculated equilibrium quantity or profit maximizing quantity. Based on it, it has been substituted to the demand function. Then we have find out price. Then this is the profit maximum profit that you can earn under the given situation. That's done. Clear? This is how it will work. This is the simple process. I think you have understood. If from the beginning, if you have gone through it, it is a very easy to understand. It is no difficult lying with this particular illustration. Okay. Sorry. Quit. Right. We have done that illustration part A, Discuss whether it would be appropriate to adopt market penetration pricing strategy when pricing COVIVAX. Mark, what is the meaning of market penetration pricing? That means you will initially charge a lower price, right? Lower price, then you will address majority of the market, because that means cost leadership pricing, kind of that market penetration. You will charge a lower price because market is highly elastic, right? Highly elastic. When the market is highly elastic, you can go ahead with market penetration pricing. But in this situation, you can see in this kind of vaccine, demand is elastic or inelastic, whether price is not material, right? Can you remember when we are purchasing vaccines, even you willing to afford or willing to pay 10,000 per vaccine, their situation. Now you can look at about the elasticity of this product. Okay, percentage change in price and percentage change in quantity. The price change is very minimal. Okay, delta percentage change in price 1000 to 1002. Price change, what the percentage? 2 divided by 1000, it is close to 0.2%, right. Demand, what is the change? Demand change 10 million reduced to 9.98 million, you can see quantity, change in quantity. Change in quantity 10 million reduced to 9.98 million by how much as a percentage? 20,000 divided by 10 million. Look at the percentage. Therefore, this is inelastic demand. Okay. Change in price, if you change the price by some percentage, change in quantity is less, right. Percentage change in quantity is lower than percentage change in price. That means your elasticity of demand is inelastic. This is an inelastic demand. Okay. When there is an inelastic demand, you need not to reduce the price. You can even increase the price and you can get more quantity. Here it says what you asked to say, market penetration pricing. No, you can go ahead with market market skimming pricing at the moment, because when this product is launched there will be a huge demand. It will be gradually decline at the end. Okay, when demand getting decline, you can reduce the price, then you can start the market penetration. At the initial page when product is introducing, you can use market skimming pricing. Market penetration is suitable when you are going to you should introduce at the later part when demand is declining. Therefore, in this situation market penetration pricing will not be suitable. Okay. You can see the answer also mentioned that this is the total computation what I have done. Okay. Here with penetration pricing, a low price would initially be charged for the vaccine with the expectation of capturing large market share. The high sales will compensate for the low price being charged. The product would rapidly become accepted as only product with buying. This pricing is appropriate. But when the demand is highly elastic, however, demand for the vaccine is not elastic, as I have mentioned. The vaccine has inelastic demand, right. When the demand is inelastic, penetration pricing is not suitable. When the manufacturer can achieve a significantly lower cost by manufacturing higher quantities, this will not be the case in manufacturing the vaccine. When there is a consistent demand for the product and product has a long lifetime, in this scenario the vaccine has a high demand presently which will come down gradually. Thereafter it has a shorter lifetime, so the company should earn as much as possible at the inception. That means at the inception you have to charge a premium price, that is we call market skimming pricing. In the latter part of the life cycle you can charge the lower price. That means because initially you have recovered the most of the cost, right. Considering the above reason, a penetration pricing policy will not be effective when marketing the vaccine, because we assume when Pfizer vaccine being introduced, have we considered whether price is high or low, because we wanted the vaccine, because demand at the inception was very high. Price is not sensitive much, no, even price is not sensitive. Even at a higher price you afford, you are willing to pay. Therefore, at the inception you can charge a premium price because demand is highly inelastic. That is the answer. Therefore, market penetration pricing is not suitable. Okay, that is the answer for question number 3, that is related to the pricing. That is done.